Hey guys, welcome back to Reserved Investments on YouTube. Okay, I got some good news for you guys, and I got some bad news for you guys. This is going to be a more financial heavy video than a lot of you out there are used to on this particular channel. So I want to warn you. So we have to put the glasses on because we got to look the part. We got the Apple Watch on. We got the wonderful Eye of Horus pennant on. So now I look like a finance bro. I don't look like Cool Sean because otherwise I would have contacts on and I probably wouldn't be wearing this t-shirt. I'd be wearing something else. I look like Finance Sean. So me talking to you about merging traditional asset investing with the antiques and collectibles trade and showing you a system that I used during the pandemic to make a lot of money and increase my net worth exponentially, I think I'm dressed the part to talk about this. Now, full disclosure, everything that I have written in the background on this poster board, I'm going to go over in depth. So you guys don't need to read this. Don't squint to see this. Understand when it comes to YouTube, I'm a big Timmy. I don't know how to focus cameras. I don't know how to edit stuff. I just film the video, hope for the best, and upload it to YouTube and see what the algorithm does with it. Okay? So just understand that. I'm going to go over everything that's written here in depth, so you will understand it by the time I am done with this video. Now, also know that I got to issue a disclaimer for this particular video. Let's be honest. I'm recording this video at 1 o'clock in the morning, okay? This is in my basement office. I'm tired. I don't even know what I'm saying in this video, to be 100% honest. So where am I going with that? Please do not try to copy this system in the year 2021. I am actually recording this video at the end of January in the year 2021 to show you guys what I did during quarantine and how I made a lot of money in both the antiques and collectibles trade and also the stock market in the year 2020 while the pandemic was raging. So this is after the fact. It does not mean, again, that I am recommending any of these investments at present time. A lot of these stocks that are selling right now that I have on this board that I'm going to go over, that I made money in, are already self-correcting to the point where they are trending up again. They are no longer selling at severe discounts. They're not undervalued. Well, some of them are. Most of them are not at present time. So please be careful if you are taking this advice verbatim. That is not what this video is for. What this video is inspiring you to do is to think in this direction if you do want to diversify assets in the antiques and collectibles trade and also merge it with traditional asset investing. I would encourage you, if you do have an interest in these topics, to study both the antiques and collectibles trade and also get educated in economics, finance, and business, because that is really what you're going to need to set up a system like this should another pandemic like COVID-20 or COVID-21 ravage the earth in the next 5 to 10 years or however long it takes for that particular virus to materialize. So without further ado, I'm going to stand up and I'm going to go through this system and how I made a lot of money both in the collectibles trade and in the stock market during the pandemic. So now, because I am a Timmy and I don't know what the hell I'm doing, understand my head's probably going to be partially cut off in this video. So I recognize that. You can look at my nice, gorgeous body that is very athletically toned because I go to the gym for an hour to 2 hours a day. So without further ado, on a serious note, we're going to get right into this. So a lot of you guys are always asking me, Sean, what are some collectibles that you get into these markets and you speculate short-term win? Now, I have done a ton of videos on this, but to reiterate, my top short-term collectibles that I make a lot of money in are Magic the Gathering, Pokemon, Nintendo products, Lego products, and other video games. And what I mean by other video games is non-Nintendo products like Sony PlayStation 4, Sony PlayStation 5, Microsoft Xbox. There's certain limited edition consoles and items that are released that I know I can flip for a profit. So I'm putting all that in the video games and other. I also make a lot of money, believe it or not. Back in 2014, 2015, when Amiibos first came on the scene, I really speculated like mad, and I was able to get a lot of first print Nintendo Amiibos at a wholesale price, and I bought a ton of them to the point where I still have tons of them sitting in climate-controlled storage units. Well, because I had all this inventory on hand, I was ready for when the pandemic struck. Now, in the year 2020, we had an interesting development that occurred. When the pandemic hit, the U.S. government decided to give most people, not everybody, if your income was above a certain amount, you did not qualify for this. But if you were on unemployment, if your hours were cut at your job, or if you didn't make the maximum threshold, you got money from the federal government, either in the form of additional money being paid to you through unemployment compensation in the United States, or they cut you a check for, I think it was like $1,200 per person at this particular time. Now, that money, along with people being stuck indoors, caused an interesting phenomenon in the collectibles marketplace. A lot of people went to eBay and Amazon, and they started buying Magic the Gathering, Pokemon, Nintendo, Lego, video games, and other mass-produced collectibles. And on the flip side, you had some people, not as much, but there were some people that were taking that money and they were investing it in the stock market at large. Now, this is very important, guys, because remember, whenever we talk about asset creation, wealth building, you have to understand that there is two sides to this equation, or this proverbial coin, if you will. When somebody goes to the marketplace, like me, I just participated in the Heritage Fund auction, and I was very bummed out because prices are so high, I didn't win one thing. So I went on eBay, and I ended up buying a $4,000 banknote because I wanted to spend money. I found it at a good price. I'm going to show a video when it comes. Anyway, I paid $4,000 for this banknote. Well, what you have to understand, when somebody makes a transaction, either on the stock market or even in the antiques and collectibles trade, if they are buying something, somebody else has to be selling something. So there is an exchange of an item or an asset class for money. Now, what does that mean? Well, what it means, we have to understand this. Money or wealth is not created, nor is it destroyed. It is simply transferred. Let me give you two such examples. I went to eBay. I bought this $4,000 rare piece of currency, which I am going to do a video on when it comes. I'm not going to spoil that. But just know I bought this $4,000 item. I paid $4,000 for this particular item. The seller of that item got $4,000. He now has $4,000 to do whatever he wants with. Me, I spent $4,000 and I got the banknote that's coming in the mail. So money was not created, nor was it destroyed in that scenario. It was simply transferred. That is very important to understand. Well, how does this relate to the collectibles trade in the year 2020? Well, what was happening was all these people that got this stimulus money who were stuck inside, they were going to eBay, they were going to Amazon, they were going to collecting groups, and they were going after some of the hottest collectibles in the marketplace: Magic the Gathering, Pokemon, Nintendo products, Lego, video games, and other items to keep them busy during the quarantines, during the pandemic. And as a result, supply started to dry up. So prices started to rise exponentially in the collectibles marketplace. Now, because we were in a full-fledged pandemic, fear took over Wall Street. So in the stock market, the opposite happened. There is an inverse relationship, traditionally, between collectible asset classes, we've talked about this before on this channel, and financial assets. Well, while the collectibles market was booming, the stock market was full of blood in the streets and fear. People didn't know what to do. People were worried about their jobs. Executives couldn't forecast financial numbers because, I'll use this as an example, Dow Chemical here didn't know how to anticipate demand for their products because people didn't have money coming in to pay their bills, or if they did have money coming in the form of the stimulus and unemployment, they didn't know what the future held. So as a result, companies in corporate America, in the S&P 500, in the total stock market as a whole, didn't know how to plan accordingly. And there's one thing that stock market investors hate. It's uncertainty. Uncertainty in the financial markets causes the overall market to fall. So anytime you have fear and blood in the streets, the stock market is going to start to nosedive. It's always been that way. It will always be that way. Now, let's review what I'm stating. Collectibles at this time in the year 2020 are rising exponentially. Certain sectors of the stock market, which I'm going to review in a minute with these stocks listed here, are starting to tank. So somebody like me who has off-site climate-controlled storage units full of Magic the Gathering, Pokemon, Nintendo, Lego, video games, and all these other collectibles, looks on eBay, looks at Amazon and says, oh my God, people are paying $50 to $70 for a Nintendo Wii game that was selling before the pandemic for $20. Or let's use this as an example. People are paying $200 for a factory sealed box of Pokemon cards that came out literally within the last 3 years that before the pandemic was only selling for $100, $110. Well, somebody like me has access to all this stuff. Now, when I go and I check my stocks, my portfolio, I see, well, gee, there's a lot of blue chip companies that because of the pandemic, because of the market sectors they were in, they were getting hammered. I mean, certain stocks like Bank of America, and I'm going to go through this list in a minute, Citigroup, Occidental Chemical, Exxon, Simon Property Group, they were getting slaughtered because people were nervous about the new normal. Everybody thinks and still thinks, even in the year 2020, that, oh my gosh, there's fear out there where, what if we never conquer the pandemic? What if nobody decides to go to shopping malls anymore? What if everybody works from home permanently and there's no demand for oil on the long-term horizon? This is causing fear in this market. So I went and I started analyzing certain stocks that are close to being blue chip potential as you can get. Meaning stocks that I knew were not going to go bankrupt. They were not going to go belly up. These stocks were not going to, anytime soon, were in risk of, how do I want to say this, debt default or severe bankruptcy status, with the exception of a few on this list, which I am going to talk about. So I made a list of certain stocks that were paying a dividend at that particular time, meaning during the pandemic, in between 3% and 8%. Now, the reason why I did that, guys, is I chose these stocks because if those stocks were paying a 3 to 8% dividend on average, and I looked at their fundamentals and I said, you know what? They can afford to pay this dividend, at least over the short term. I knew that even if I held these stocks, I would still get a substantial dividend while I'm holding the stock in question. Now, to be fair, I know what my brothers and sisters out there that are educated in finance are going to say. Well, Sean, there's no guarantee that these companies could still afford to pay that dividend. Even in the year 2021, if you're holding any of these stocks on this list, which I am going to read off in a minute, I know I keep saying that, there is a chance that they can cut their dividend at any time in the future. And that is a fair assessment. That's why I tell you guys, if you are investing for the long term, you are better off putting your money in like a 500 index fund, a total stock market index fund, a dividend growth fund, or even, I'm going to recommend another Vanguard fund on this list. I'm going to be 100% honest, the Wellington Fund, which is made up of both stocks and bonds. But over the long term, it does have an excellent track record. So this is why individual stocks can be very risky. We don't know what the future holds. Now, I already know what you're stating. Sean, we're 14 minutes into this video. Please tell me what stocks you went after during this wonderful, crazy time. Well, it didn't take a genius to figure out that the stock market, that the sectors that were hit due to the pandemic were pretty much in the industrial space, the financial space, the real estate investments trust space, which is Reits, and also oil and energy. So the stocks that I chose to target were Altria, 3M, Dow Chemical, Bank of America, Citigroup, JP Morgan Chase, Iron Mountain, AT&T, Occidental Chemical, Exxon Mobil, Simon Property Group, and Realty Income. So I chose a diverse collection of stocks across the industrial consumer staple sphere, the financial markets, the real estate investment trusts, and also oil and energy. Now, this is where it gets interesting, guys. And by now, all the Timmies, Kimmies, and Poindexters who don't like where I'm going with this, they already shut the video off. So it's just me talking to you guys. This is where it gets great. You're going to love this. All these stocks on this particular page right here, I have all these stocks listed, and I have their 52-week low price and their 52-week high price. Well, naturally, guys, we were in a pandemic. So all of these stocks got clobbered to the point where they were all trending. Obviously, most of these stocks hit their 52-week low periods during the pandemic. So let's look at Altria. Altria, under normal circumstances, is usually a stock that hovers around $50, $51 a share. The 52-week low price of Altria was $30.95. The 52-week high price of Altria was $51.04. 3M is another great stock that got clobbered during the pandemic. The low price, the 52-week low of 3M, was $114.04 with the high price of $180.59. Do you understand how much money you would have made if you would have just went after 3M stock, even if it was at $130 a share? It's now selling a lot closer to the $180 price at present time, and we're still in the pandemic, guys. A lot of these stocks already started to recover. That's why I'm telling you, if you're going to replicate this system, understand a lot of these stocks are already selling closer to their 52-week high prices than they were literally several months ago. So just keep that in mind. Next, let's look at Dow Chemical Incorporated. Now, I love Dow Chemical. Dow Chemical most likely pays a dividend anywhere from 4 to 5% on average. Well, during the pandemic, the 52-week low price of Dow Chemical was $21.95 a share. And guess what? The 52-week high price is a little around $60, $61 a share. So you can see the variance there. There's like a $40 spread in the last 52 weeks due to the pandemic that affected Dow Chemical alone in that particular manner. Let's continue. Bank of America. Does anybody out there think Bank of America is going to go to zero anytime soon? Well, during the pandemic, Bank of America hit a low price of $17.95. Well, guess what? It also had a 52-week high price before the pandemic of $35.45. So if you were buying Bank of America, in my opinion, and you bought it during the pandemic when it was $25 a share or under, you did fantastic. Because even today, at the filming of this video, Bank of America is back up to $31 a share. And not only that, at $31 a share, you're getting a 2.2% yield on your money. So that's how you play this system. But let's continue. Let's look at Citigroup. Citigroup is a blue chip financial company. Let's be honest, every Timmy, Kimmy, and Poindexter out there watching this video, even if you know nothing about finance or investing, you've heard of Citigroup. Well, Citigroup dropped to $32 for a low price in the last 52 weeks during the pandemic, with a high price of $80.76, guys. Let's continue. JP Morgan Chase, 52-week low of $76.91, 52-week high of $142.75 a share. You seeing a trend here? A lot of these stock prices were cut in half, where if you would have took advantage of this particular stock market crash, or mini crash as it was, you would have made money as the market corrected. Let's continue. Iron Mountain stock. Now, full disclosure, Iron Mountain is not a growth stock. Iron Mountain, much like AT below it, is a value stock. So both Iron Mountain and AT&T are pretty much value stocks right now. Well, during the pandemic, Iron Mountain stock fell to a 52-week low of $21 a share, with a 52-week high prior to the pandemic of $34.49. Now, one thing about Iron Mountain is set up as a real estate investment trust, which means, per IRS regulations, 90% of their revenues have to be paid out in dividends. Iron Mountain today pays a dividend of 8.2%, amazingly. AT&T fell to a low 52-week price of $26.08. Prior to the pandemic, it had a 52-week high price of $38.99. AT&T pays a dividend at present time in the neighborhood of 7.1%. That's a very high dividend to be paid out, even in the year 2021. Let's continue. Occidental Chemical. Now, this we got to have a little bit of a discussion about. Occidental Chemical is not, at present time, a well-run company. Occidental Chemical made a lot of risky decisions to the point where they took on a lot of debt. So, really, Occidental Chemical was selling at one point, and I don't have the correct number here, at one point during the pandemic, Occidental Chemical hit $9 a share. Well, the 52-week high is $43.60. Now, at $9 a share, does anyone think Occidental Chemical isn't a buy? They are a major oil producer. And regardless of the fact that they have too much debt, they still have a lot of assets that justify the cost of their company at $9 a share. So what I'm getting at, those of you that are educated in finance or those of you that want to learn how to analyze stocks, you can make a lot of money just with this knowledge, knowing that, hey, Occidental Chemical just dropped to $9 a share. They're not going to go bankrupt anytime soon. At $9 a share, I will literally buy as many shares as I can afford. So that's what is great when you have that type of financial backing. You get that knowledge, you know how to analyze stocks in that manner. Well, let's continue. Let's look at Exxon Mobil. Exxon Mobil, even to this day, has a dividend of 7.3%. Now, I get it. A lot of people are not driving to work still in the year 2021. So Exxon Mobil is still hurting. They're not out of the woods yet. But does anyone not believe that Exxon Mobil, which had a 52-week low price of $30.11, does anyone really not believe that Exxon Mobil isn't worth $30 a share, even in today's terms? Well, they had a 52-week high before the pandemic of $66.93. Now, I know you guys are getting bored with this, so I'm going to just do two more, and then we're going to talk a little bit, and I'm going to show you how wealthy people make money by having a position both in securities and also antiques and collectibles, and how you can use some of this money to further expand your empire by investing the dividends that these stocks are paying out in certain mutual funds that are meant for long-term investing. So last on our list are two Reits, real estate investment trusts. The first one is Simon Property Group. If you've ever heard of the King of Prussia Mall, Google it. It's one of the largest shopping centers on the East Coast. I literally live within 25 miles of the King of Prussia Mall. I go there twice a month on average. Well, Simon Property Group owns the King of Prussia Mall. They own a lot of high-value retail space. That stock fell when the pandemic hit to $42.25 was the 52-week low, with the high price prior to the pandemic of $147.80. Now, does anybody not see the value in buying Simon Property Group for $42.25 a share, even with a raging pandemic? Well, I did. But last but not least, we're going to talk about Realty Income. Realty Income is another REIT, real estate investment trust. It pays a dividend yield currently today of 4.7% based on today's stock price. Well, during the pandemic, it dropped to $38 a share. Well, guess what, guys? The 52-week high of this particular stock was $84.92. Now, let's put all this together because I threw a lot of information at you. You guys out there that put in the comment section, Sean, you don't know what you're doing. You put a lot of your money in stocks, bonds, traditional assets for the long term. I hope the stock market crashes and teaches you a lesson. Well, come here, little Timmy. Guess what? During the year 2020, it did crash. You aware I made near 6 figures doing this while we were in quarantine? Why some of you out there were reaching out going, Sean, you don't understand finance. You don't understand business. I'm putting all my money in Pikachus, Planeswalkers, Marios, and Sonic the Hedgehogs. Well, guess what, guys? I took all the money that I had in these mass-produced collectibles, and I sold as much as this crap as I could for what the market would bear. And I threw it all into undervalued dividend-paying stocks. And now as the market corrects, guess what? I'm riding the wave up. And you know what I'm going to do? This is where the most important part of this piece comes into play. As all these stocks correct and they go towards their 52-week high prices again, I'm selling them. I'm taking the money that I made in these stocks and I'm coming down here and I'm investing in index funds and mutual funds for the long term. Now, a lot of you guys reach out and you go, Sean, what mutual funds do you like? Well, I'm going to focus solely on Vanguard right now. I'm not going to go into my my Charles Schwab holdings, my T. Rowe Price holdings, or my Fidelity holdings. I'm just going to talk solely about Vanguard. Vanguard has 4 funds that I recommend for the long term. And again, I probably shouldn't state that, but if you have 10, 20, 30, 40 years out, these are all top-tier mutual funds that I recommend the average long-term investor who understands risks of the market, both in the short term and the long term, get involved in. Those funds are the S&P 500 Index Fund, the Total Stock Market Index Fund, the Dividend Growth Fund, and the Wellington Fund. All those funds I recommend. So let's do a quick review. I took all these collectibles that soared in value due to the pandemic. I cashed out. That really didn't look too proper, did it? I got to quit doing that on camera. That looks a little weird. Okay, I took all the money from them and I went after undervalued stocks that took a nosedive thanks to fear and blood in the streets. So I sold out all of these collectibles that I had and could sell at a very high price. I then took that money and invested in undervalued stocks, okay? That paid me a dividend while I wait. Now as the market corrects and trends upward again, I'm selling a lot of these stocks. I'm taking the gains and I'm putting it into long-term mutual fund assets. Do you understand how the rich get richer as asset prices increase? This is why you cannot put all your money in gold, silver, cryptocurrency, real estate, or Pikachus, Planeswalkers, rare coins, traditional antiques. You must have money available to take advantage of market dips and market rises. Whether you're playing collectibles or whether you're playing stocks or whether you're doing what I'm doing, a combination of both. That is how you create wealth in a capitalistic society. And this is going to tie right in to part 3 of my 4,000 subscriber Q&A, because a lot of you guys tell me, Sean, what are the differences between making money and building wealth? This is how you build wealth. Learn this, guys. It will set you up for life. Thanks for watching. Have a great night. Let me know your comments below. I want to know your feedback on this video. Did you like this video? Did you hate it? What are your thoughts? Thanks, guys.